Today, we're all about paying more in taxes. Well, kind of. We're all about paying more in taxes today so that we can save money on taxes across our lifetime. And we do this through the magical power of Roth conversions. Now, Roth conversions are fairly straightforward. You convert your pre-tax IRA money to your Roth IRA. Now, the conversion itself from the IRA to the Roth IRA, it is a taxable event. So whatever amount you move from the IRA to the Roth IRA, it is going to be taxable in the year you do the conversion. Now, the benefit of doing this is that, any money that you put in the Roth IRA, it grows tax-free, assuming, of course, you play by a few different rules. But the trade-off is that you have to pay federal income taxes on the amount you convert today or this taxable year. So that brings up the million-dollar question. How do you know when a Roth conversion makes sense? You're thinking to yourself, the idea of tax-free money sounds great, but I'd have to pay taxes today, which I hate. So how do you make this decision? Well, there are a few different things to really look at. So instead of yammering on and talking theory, let's look at a sample case study. We're going to continue on with Evan and Sophia Kessler. If you're not familiar, I did a video that you can find right here where I went over their situation. I'll also link to it in the show notes. We're going to continue that exact same case study. So let's just jump right in. So this is their cash flow overview. So this is just an overview of where all their money is going as things currently stand without doing any type of Roth conversions. Now, looking at this, you could see that they get Social Security every single year. 2024, they start off by getting $52,000 a year in Social Security, and the next year they get a little bit more with an inflation bump, so on and so forth. Now, this red line that you see in the graph here, those are their total expenses that they need every single year. So as you can see in the first couple of years here, 2024, 25, 26, 27, 28, 29, 30, 31, the Social Security doesn't quite cover their expenses. So like it says here, in 2031, they have to take money out of their retirement accounts to cover the shortfall. In 2031, they only need to take out $9,536. But something happens in 2032 when they turn 73. RMDs. You could see the orange bar starts to go off here, and it's more than what they need expense-wise. So you can see in 2032 here, the RMDs plus their Social Security is more than what they need expense-wise. Getting a little ahead of myself. RMDs, that's basically the IRS saying, look, you have money in your pre-tax retirement accounts. You're going to have to start taking some of that money out. It's a tax law, and you have to take out a little bit in the first year. For them, it happens when they turn 73. For some people, it's going to happen as late as 75, but for our sample client here, it's going to happen at age 73. And this is a little bit of a problem because it essentially is forcing you to pay taxes in a year in which, you don't even need the money out of your retirement account. So that makes things a little difficult. And you can see it happens every single year. So in the very first year, 2032, they have way too much money coming from RMDs. So we need to try to fix that. You can go down here and see their cash flow overview. And you could tell in the first, like I said, 24, 25, 26, 27, 28, 29, 30, 31, first few years here, they need barely any money out of their retirement accounts, between $8,000 and about $9,500 a year. And at the same time, on the right-hand side, you could see their portfolio assets just grow and grow and grow and grow because of the fact that they don't need any money out of their accounts until they get all the way to 2032, in which they're going to have to start to do RMDs. But by that time, over 8 years, their money's almost doubled from $1.1 million by the end of 2024 all the way to a little more than $2 million. So definitely some planning opportunity for us. So now we're looking at their total taxes paid. And as you can imagine, because they're only taking Social Security and only a tiny bit out of their retirement accounts, they're paying $0 in taxes because they're way below the standard deduction. So for the first, 8 years here, 24, 25, 26, 27, 28, 29, 30, 31, they're not paying any taxes. Which if I were to tell a client that, they'd be thrilled, be, over the moon, like, great, we don't have to pay any taxes for the first 8 years. Yeah, sounds fantastic. Until you get to year 2032. Then the RMDs start to kick in. And once again, you're taking out more money from your accounts than you actually need. So you're creating a taxable event when there's really no advantage of creating the taxable event to begin with. So it's an issue. And like I said, every year the RMD it's small at the beginning, but then every year after that it gets a little bit bigger. Without getting kind of the details of the RMD, you could tell in 2032, now we're paying $12,500 in tax. Next year, $14,300, so on and so forth until 2054. They're paying a lot in taxes there. So with Roth conversions, the idea here is to kind of pull some of that taxable event kind of to the front, to the first 8 years. What if we were to create some tax in the first couple years here so that we potentially don't have to pay any on the back end? That's the whole idea of doing a Roth conversion. So going back to the top here, that's exactly what we're going to do. I'm going to implement some Roth conversions, and we're going to see how that changes things. So here's the result of doing the Roth conversions. You could see in the beginning in 2024, we did some Roth conversions, created some tax. We're going to pay some tax essentially in 2024, pay a little bit more in 2025, so on and so forth, with the intention of moving money from our pre-tax accounts and moving it to the Roth IRA. So now in these first 8 years, we didn't even need really a lot of money out of our retirement accounts. So we could do these Roth conversions and we could start to move money inside of our Roth IRAs and get Roth money growing from there, which is fantastic. You could see every single year, first 8 years, this really helps us. Then when we get to 2032, 2033, 2034, things start to flatten out, and then look what happens on the back end. These gray bars here, that's a reduction in taxes, which is obviously fantastic. So we're saving a ton in taxes, like it says here. Cumulative taxes right in the middle. We're only paying $446,000 cumulatively in taxes, which is about $1.5 million less than not doing Roth conversions, which is fantastic. It's also going to save us about $670,000 in total portfolio assets across our total lifetime, which is obviously amazing. Now, if we go down here, you can see once again, hey, we were in the 0% tax bracket the first 8 years, but now we're not. Now we're in the 22 to 25% tax bracket, just creeping up into those tax bracket. And I could show you what the tax brackets, because I know you're dying to know. So let's take a peek. So you're looking at the tax brackets here and you're thinking to yourself, well, how much do I convert, Jeff? I don't really know how much money to convert every single year, into doing like Roth conversions. I'm a pretty big believer that every single person should fill up the first two, as the tax brackets stand now, the first two federal income tax brackets. Those brackets are just so low, 10 and 12% as they stand right now, that it just kind of makes sense to fill those brackets up with Roth conversions, especially if you're in retirement. But I feel this way even if you're, not in your mid 60s like Evan and Sophia here. I feel that if you are, going through a layoff or something and you have a low taxable situation, definitely some opportunity if you have money in your IRAs or in a brokerage account or something like that. So with that said, we can scroll down here. We can see how much we actually did in Roth conversions. You could see we did a lot. 2024, we did 73,000, 25, 75,000, so on and so forth. Just filling up those first two brackets. We creeped into the third bracket here a little bit here, but that's all right. So now we go back to the cash flow overview. You can see how that changed greatly. That orange line, once again, or the red line, I should say, that's total expenses. And you can now see that we don't really go over the red line much. We do a little bit here, but pretty much we have enough money in our Roth IRAs now that we can sufficiently say, RMDs aren't, kicking us in the butt here. We're doing okay, and the RMDs aren't putting us in a bad position. Social Security, between that and money we have coming out of our Roth IRAs, now that all that money's tax-free, that makes a huge difference for us in saving us a ton of money. So let's look at the balance sheet, because I think this is really, really important. When we looked at the tax overview earlier, let me pull that up again just so we're looking at it. You saw that by doing Roth conversions, this little number down here, $670,000 versus base taxes, versus base facts, which is basically saying like we're ending up with $670,000 more dollars in investable assets, total portfolio assets here, as compared to not doing Roth conversions. Well, I think that number is maybe a little misleading in terms of the type of money that you're potentially, that Evan and Sophia here are going to potentially die with. So if we look a little closer and kind of look under the hood here, if you will, You'll see going over their balance sheet, this is how things stand today. But as of the, let's go to the second death here, and you'll see where they both pass away. They have more money in investable assets, but not only that, they have $7.9 million in Roth IRAs. Basically, imagine giving your heirs $8 million tax-free. You're basically, when they pass away here, they're going to be giving their kids $8 million here in almost tax-free money. I mean, that's incredible. You could make an argument here that they potentially should be spending more money in retirement, and I would maybe make another video on that, but that's an argument for another day. But the fact of the matter is that because they did Roth conversions, they are now leaving $8 million to their kids or whatever heirs they want to leave them to, as opposed to, if we look at the base facts here, this is without doing Roth conversions. You could see they leave $2.8 million in basically just IRAs, and the rest is just in taxable investments. So it's not quite the same. Being in Roth IRAs, completely tax-free money. So when you're doing an apples to apples comparison, in one scenario, you are leaving more money doing Roth conversions, but not only that, you're leaving more money on like a net basis when you factor in taxes, which I think is very, very beneficial. Roth conversions can be very powerful when implemented correctly, as you just saw. But there are some other things you do want to think about. Now, the first one are your heirs. If you're doing some multi-gen planning, you'll want to consider the tax situation of who is inheriting your money. Now, your beneficiaries who are in a higher tax bracket, they're going to appreciate inheriting Roth IRA assets. Your heirs who are in a lower tax bracket, they probably still want the Roth IRA assets, but it might make more sense for them to kind of inherit your pre-tax IRAs since they're already in a low tax bracket. Second, you should consider taxes in general. Now, my simulation assumes tax rates and the tax brackets. It assumes they increase with inflation like they do every single year. There's always the possibility that Congress implements some new tax law to increase or decrease taxes. Now, I'm not trying to predict or tell you that taxes are going to go up or down in the future, but having some money in Roth and some money in pre-tax might be a good hedge for future tax changes. Evan and Sophia are starting their retirement journey with about $1 million. Is that enough to retire? Is it too much? Click this video right here and you'll find out. I'll see you there.